Hello, I'm Mi-jin Woo from Michigan University, starting today's Michigan News on April 11th. As always, we welcome you to Mi-jin Woo, who is maintaining the norm of United States stock investment today. Friday has come around again. As I've mentioned a few times recently, when the movement of the United States stock market is not good, like recently, taking a step back from the stock market for a while can also be a wise investment strategy. During the upcoming weekend, forget about the United States stocks for a while and focus on what you love doing over the weekend. It would be wise for investors to relieve all the stress. And as I've mentioned a few times, next week, it seems difficult to properly broadcast the retirement through United States stocks. I think I should take a week off, but recently many of you have been very fond of the United States stock footage attached to the broadcast I send. Perhaps because the market situation is so volatile, there is a lot of focus on what opinions the current market experts are offering. So, because I won't be able to send a proper broadcast next week, I'm planning to at least create and share a piece of United States stock footage with you all. I would like to apologize again for not being able to send a main broadcast for a week. I will do my best to continue updating the news in the Ms. on all-in-one membership that I operate as I find time, so that there is no gap in progress. Well, then let's start today's Big Two News, which will be sent on April 11th right away. Today, I will take a moment to look at the situation of the United States stock market yesterday. First, if you look at the S&P 500 index, overall, the market recorded a downturn, and particularly, there are hardly any rising stocks in the tech sector. You can also see a lot of red, indicating a significant drop. After the United States stock market experienced a historic rapid rise, we saw a moment of pause yesterday. All three major indices fell sharply. 2.50% S&P 500 by 3.46% and Nasdaq by 4.31%. In the case of 12% just yesterday, then rose 12% and rebounded 4%, it seems possible to calculate in this way. Seeing the United States stock market fall sharply again yesterday, there will be many investors who are a bit disappointed or have lost their momentum. Personally, I continue to strive to remember two facts when the market is tough like this or when it shows a pessimistic movement. The first one is, we call the stock market a market. Why? Because transactions occur within the stock market. People who want to buy and people who want to sell are simultaneously bidding. That's the stock market. So, if there are many people who want to buy, the stock price goes up. And if there are many people who want to sell, the stock price falls. This fact is extremely important. If you look at the recent movements of the United States stock market, last Thursday and Friday alone, the United States stock market plummeted by 10%. And then as of yesterday, it surged more than 12% based on the Nasdaq standard. Well, what we should consider at this stage is probably those who wanted to sell have all sold. And then on Wednesday, the United States market sharply rose, among which some investors are people who are not sure, or in the second case, short-term investors. That's why there's no need to be disappointed that the stock price dropped more than 4% like this yesterday. From what I see now, I think a slightly sluggish bull market, that is, the box power will not collapse. If you ask why the box power is predicted when the stock price has fallen so much, it's because a kind of stagnation begins from now on. You should see it this way. Last Thursday and Friday, when the 10% circuit breaker collapsed, I think everyone who actually wanted to sell sold. From now on, it would be extremely difficult for the stock price to fall below this level unless something happens. On the other hand, there are people like me who are now holding stocks, and for your information, in my case, more than 90% of my total assets are currently in the stock market. If someone like me sells, the stock price will fall. And conversely, last Thursday and Friday, people who dumped all their stocks have to buy stocks for the price to rise. But now the possibility of either side taking further action is extremely low. Why? Because there aren't many investors left with stocks to sell since they dumped all their stocks last Thursday and Friday. And on the contrary, those who have held onto their stocks until now are less likely to throw more stocks because they have survived last week's crash. So, from now on, won't the stock price repeat ups and downs due to short-term investors, like it surged over 10% on Monday and dropped 4% yesterday? Therefore, I personally judge that it will not be a bullish market for a while as traders make the stocks fluctuate, and investors with a medium and long-term perspective will not move. Well, and the second point I want to mention is this. When the stock price continues to rise or fall, instead of just watching the stock price in the stock box, let's look at the actual earnings multiple. I would like to mention this. For example, TSMC announced its sales performance yesterday, and the sales in the first quarter increased by more than 40%, 42% to be exact. That's what I'm talking about. TSMC is showing the fastest growth rate after 2022. It means that companies are doing very well. Despite this, if the stock price continues to fall, TSMC's forward price earnings ratio has now fallen to 16.72 times. Price earnings ratio is the price to earning ratio. It calculates how many times the market capitalization has risen compared to the net income expected to be made in 1 year. What does a price earnings ratio of 16 times mean? If TSMC stops growing from now on and makes the same net profit every year, it means that it can cover the market capitalization with net profit after about 16 years. Investors who buy TSMC stock now can recoup their initial investment within around 16 years, even if the company's growth halts. That's how the math works out. But the problem is TSMC's growth rate is currently 40%. So, when we talk about 7 times in 16 years, it's not just about that, but how many years in the future you can recover all your investment. That's how you should see it. We usually call that polyethylene glycol, right? If you take the growth rate into account and recalculate the PE, even if it's 40 times, it drops to 0.42. So, when we take the growth rate into account, the current valuation of United States stocks is extremely low. So at some point, this kind of valuation will recover, or the earnings will continue to rise. Remember, it's incredibly important that the stock price will naturally recover and there's nothing else it can do. Of course, no one knows whether this stock price recovery will happen this week, next month, or even in a few months. However, if we remember that the stock price is a multiple of earnings, we can maintain the hope that the stock price can eventually recover. The reason why the United States stock market plummeted last Wednesday is because of the news that President Trump was going to impose tariffs. However, the reason why the United States stock market fell again yesterday was not due to any particular bad news. Rather, it was a case like yesterday. There was one good news, but such good news was overshadowed by worries about the future. You should see it this way. I will try to explain from this part what the good news announced yesterday was and why such news was highlighted. The Bureau of Labor Statistics announced the March index of Consumer Price Index on Monday morning, and the result was incredibly good. The headline Consumer Price Index year over year compared to last year increased by 2.4%, and economists' forecast was plus 2.6%, a lower figure by 0.2% was reported. Compared to the previous month, the headline Consumer Price Index recorded negative 0.1%. The forecast was plus 0.1%. Next is the Core Consumer Price Index compared to last year. It increased by 2.8%, and the market's expectation was plus 3.0%. Lastly, if you compare the Core Consumer Price Index with the previous month, it increased by 0.1%, but while doing so, a lower inflation figure than the expected plus 0.3% was announced. So overall, all the numbers were very positive. We are seeing a trend of inflation being much more subdued than expected. So originally, the market had to worry about volatility, but this good news has eased due to concerns about the future. This is how it can be explained. It's the Consumer Price Index that broadly measures the cost of goods and services in the United States economy. The Consumer Price Index recorded a remarkably good inflation rate, rising to 2.4% from plus 2.8% in February, even compared to last year, while falling 0.1% compared to the previous month. Core inflation, excluding food and energy, rose 2.8% annually and 0.6% month over month, which is quite good. And this figure is the lowest core inflation rate since March 2021. So a huge commotion has occurred. Especially, the drop in energy prices has helped to curb inflation. The 63% drop in crude oil prices contributed to a 24% drop in energy costs, while food prices increased by 0.4% compared to the previous month. So why have food prices increased more than the rest? It's because of the well-known egg prices, which have skyrocketed by 60.4% compared to a year ago. Lastly, the most crucial component of inflation is housing prices. It rose by 0.2% in March, and on a 12-month basis, it increased by 4% compared to last year. If so, it recorded the smallest increase since November 2021. This has a very significant meaning. 1/3 of the consumer price index is housing prices. So if housing prices continue to fall, it could lay the groundwork for the consumer price index to continue to fall. Another aspect of housing prices is their gradual change. Currently, they have begun a slow downward trend. Inflation will likely continue slowing down in the future, which can be seen as a positive sign. Used car prices fell by 0.7%, while new car prices rose slightly by 0.1%. However, this part is expected to reduce the burden on the auto industry, and the figures announced in front of the tax are very important for how car prices will be in the future. You can think of it this way. In this announced Consumer Price Index report, President Trump announced that he would delay some of the most aggressive tariffs imposed on hundreds of countries, and part of the tariff plan came out just a day after it was postponed. Instead, President Trump maintained a 10% uniform levy on all imports announced last week. It is understood that a period of 90 days has been set, during which the combined tariff can expect higher tariffs. Most economists predict a significant increase in inflation due to the impact of tariffs. The situation is now uncertain because President Trump has opened a window for negotiation. Given that the news changes every day, it's almost impossible to predict the future accurately, if you think about it. KHEI, who is in charge of power and mobility solutions at Goldman Sachs, is coming out. The Consumer Price Index, which was announced today, came out lower than expected, giving a sense of revisiting past figures due to the major changes in recent monetary policy. It's a very accurate expression. In fact, the Consumer Price Index should show the current trend, but now it's changing so fast that we can't know the future. Therefore, a month ago, the Consumer Price Index felt like a very old number, and I'm explaining it like this now. Going forward, the annual rate will start to reflect the price increases due to taxes, and if the economic activity remains sluggish, it is expected to be left to difficult choices. The annual rate has two goals, right? The first is to control inflation, and the second is to stimulate the economy. It's about stabilizing the job market so that people can work. But the tricky part now is there's a possibility that the authorities could ruin both of these. Inflation could rise due to inflation, and the economy could stagnate due to the economy. So it's a time when you have to choose between the two. And it's incredibly difficult. That's what I'm talking about. After the Consumer Price Index report was released, the bond market showed little change in market expectations for interest rates, and traders are predicting 3 or 4 rate hikes by the end of the year. The interest rate is expected to be lowered 3 to 4 times. It is crucial that inflation does not increase, as it is widely anticipated. Therefore, the fact that the inflation rate in March is much lower than expected is. Even a few months ago, it would have been data that would have made investors cheer. Considering only yesterday's data, the United States stock market is justifiably soaring high. However, even though such a large rally is being observed right now, in fact, because there is a lot of anxiety about the future, it was not able to maintain its bullishness, you see. Despite this, the Consumer Price Index is clearly bullish. Now, at the annual level, we have the leeway to take a breath of relief. However, the situation has significantly changed in recent months. In the current situation, it's difficult to precisely determine how much President Trump's fiscal policies will affect the United States economic situation and the world economy. Because of this, I personally believe there is a high possibility of maintaining a cautious mode in the short term. This means that the Fed's move we are waiting for is likely to be very uncertain, and no one knows when the Fed will step in or if it will help us. Because of this, as I mentioned earlier, rather than a V-shaped recovery from now on, I think it is more realistic to expect a steady low-point rise mode. That's what I think. Short-term investors are now likely to influence the stock price according to the statement. So people like us who look at it in the long term, the people who sell have all sold, and the people who buy have all bought. So from now on, when it goes up and down, the possibility that traders will do this is high. So wouldn't it be a bit difficult for a V-shaped recovery to occur? The market needs to help, but this is a bit difficult. So depending on the market news, especially news related to Trump's tax policy, it will continue to repeat zigzags. But whether this is a continuous drop or a continuous rise, I think we need to focus on this part. Looking at the futures of the United States market ahead of Friday's opening, all three major indices are showing a minus. The Dow Jones futures are down 0.29, the S&P 500 is down 0.25, and the Nasdaq is also down 0.04%, showing a slight decline. Just a few hours ago, the Nasdaq was showing an upward trend of about 1%, but the atmosphere suddenly cooled down. There was one reason for this. Before I started the broadcast, before recording, an hour ago, there was news that I delivered to the existing members through a tip. The not-so-good news that the Chinese government will impose a 125% tariff on American products from April 12th has been reported. China has retaliated against President Donald Trump's trade tariffs by raising tariffs on American products from 84% to 125%, the Ministry of Finance revealed on Friday. The statement is here, and its content is incredibly simple. It didn't explain in detail, so what was the content? Even if the United States continues to impose higher taxes, it will no longer be economically affected, and it will be a historic event in the world economy. What this means is that there is no difference anymore because it has already exceeded 100%. It has risen as much as it has been raised. Stop doing such ridiculous things. This is what I'm talking about now. At the current tax rate, Sung Myung revealed that there is no longer a market for American goods imported into China. What I'm saying is, the tariff has already risen to 145%, so even at this level, there is no one in China who buys American goods. And if the United States government continues to raise tariffs on Chinese goods exported to the United States, China will ignore this, he says. This part is a bit interesting. The story is that even if the United States government raises it more than 145% with this measure, China will not follow, he says now. So when I see it, I rather think it has lowered the bar a bit. Therefore, if the United States retaliates again, it has been revealed that they will not respond to it. The Trump administration confirmed on Monday that the current tariff rate the United States imposes on Chinese imports is about 145%. Hopes for negotiations to resolve the United States-China trade war are quickly fading in today's news. Therefore, there is a high possibility that we will continue to see this back and forth between China and the United States for the time being. Goldman Sachs has downgraded its forecast for China's gross domestic product growth to 4% on Monday, taking into account the downturn in global growth slowdown caused by the United States trade war. It is estimated that the goods China exports to the United States account for about 3% of its total gross domestic product. However, what is the reason for downgrading the gross domestic product growth rate to 4% despite this? We're discussing the potential significant impact on employment. Therefore, according to Goldman Sachs, the people who are working on products exported from China to the United States, which are about 1 million to 2 million people, may have no choice but to bear the brunt in the job market. Anyway, we need to keep an eye on when and how China and the United States will change their stance. The next article prepared is about the forecast for the United States stock market. The content is extremely pessimistic. However, despite this, the article is very logical and well written, so I think it would be good for everyone to read it at least once. Lastly, I will also attach my personal opinion that I have and read it together. I wrote the abrupt title. It's about why we should reduce the weight of United States stocks during the tax holiday period. So it's a bit negative to the extreme. President Trump is once again the focus of economic speculation in the United States, as he postpones tariffs on all countries except China for 90 days. What about this story? Even a few days ago, the United States was finished. The United States is in big trouble, and suddenly the economic exceptionalism of the United States is rising again, how volatile the United States economy is, and the number of articles praising it like this is increasing. The focus has shifted to the United States tax cut, another point of contention. Until now, we've only talked about taxes, but finally, because taxes are gradually being reduced, companies can raise wages, and such positive views are being expressed. Another thing, Scott Minerd, who replaced Peter Navarro, the architect of the zero tariff policy, is promising a more conservative approach to tariffs. Just a few days ago, Navarro was the one most frequently appearing in the news, a person who maintained a rather aggressive tariff policy. On the other hand, Minerd, the Secretary of the Treasury, is all in. But recently he's only been about 1 or 2 steps away from 100%. Therefore, Navarro's sudden disappearance from the news is very unsettling, and such an assessment is possible. However, the tax doesn't completely disappear. Rather than a complete policy shift, this article takes the position that it's a temporary suspension, if you see it this way. The geopolitical and economic policy issues that tariffs can address are still very much present. This is crucial. The person who wrote this article would say that tariffs will always be our problem because tariffs can address 2 things, geopolitical issues and economic issues, and that's what's happening right now. Despite this, it is clear that the stock market has gained a sense of security after President Trump's speech on April 9th. Investors were relieved when President Trump signaled a more gradual tariff, a comprehensive tariff, by criticizing the agreement. I was so happy when the weather suddenly cleared up. Investors received a signal that the Trump administration's position is a compromise for a global tariff. Until then, there was no sign of such an extremely rare voice. So you can see that some of the uncertainty has disappeared. However, not all the news coming from Washington is positive. The geopolitical uncertainty due to the long-term conflict between the United States and China remains at a serious level, exceeding 100% due to customs duties. President Trump is using tariffs as more than a simple trade barrier. This is the key point right now. Tariffs are a weapon used by President Trump to intimidate China in order to complete the biggest geopolitical risk that has continued for over 50 years. President Trump is using tariffs to resolve the geopolitical divide that has continued for the past 50 years. That's the main point. And this is about ending the 2-tiered hot war and talking about an endless war. This includes ending the war and stopping the threat to Taiwan. The ongoing tax negotiations can only bring unpredictable instability and shock to the market. If the United States cannot resolve all major disputes within 90 days and a significant amount of tariffs remain, it is simply more than an investment risk. It is extremely dangerous, which is the current situation, hence why we are discussing it now. Therefore, it is said that the monthly rent cannot be satisfied with the sense of victory in the tariff war. Why? Because so far it has not been a victory in the tariff war. And furthermore, Wall Street predicts that it will not be able to block tariffs. The reason is that geopolitics is the core force that moves United States economic policy, whether it's tariffs or taxes. President Trump cannot eliminate or end tariffs like magic, because tariffs are the most important means to solve major geopolitical and economic problems. The problem I mentioned earlier, tariffs are more than a tool. The important thing is, what Trump wants to do now is to solve geopolitical issues. Second is economic problems, fiscal deficits, and finally, the perennial trade deficits. Therefore, tariffs are for solving economic problems, geopolitical problems, and will always remain. This is what I'm talking about. However, the stock market is constantly fluctuating and integrating. One of them is the illusion that President Trump considers the market important. That's not the case. This gives investors the expectation that President Trump will not have a significant negative impact on the market. The situation that emerged last week, namely the stock market crashing 10% on Monday and Friday, shows that such judgments are wrong. The president cannot only see his responsibility, priority, and goals from a single perspective. We must understand that the Trump administration and the financial market are in a different world from Trump's first term. Thus, I conclude. There was a similar trade war during Trump's first term as president. However, after that, the United States stock market has a steep climb. This time it's different. Geopolitics is Trump's top priority. It's his turn now. In order to solve geopolitical issues, we must not ignore the water. And secondly, geopolitics is deeply intertwined with economic policy. So in order to solve economic policies, we must solve geopolitical issues. Well, and finally, for economic policy, the United States is striving to achieve the geopolitical goals it seeks. So economic policy can also be left or right due to geopolitical goals, and it is possible to understand that it is now explaining this complex relationship. The trade deficit is the largest component of the United States' current debt. The country's numerous financial deficits, including the trade deficit, contribute significantly to its overall debt burden. Therefore, if this is not resolved, the United States will continue to be in a difficult economic situation, and it is Trump's dream to resolve this situation. This is what we are talking about now. Therefore, today, the market is far more recognizing the dominance, influence, and power of the United States, and is undermining the power to protect the United States and the global community. Let's talk about this again. Now, President Trump, the leader of the United States, is not interested in the dominance of the United States as much as the market thinks, or in cooperating with other countries, or even in protecting the global allies. The current President of the United States is interested in solving geological issues, and because there are too many stakeholders in the current debt crisis, it is possible to interpret that he is interested in solving the financial deficit. Therefore, investors need to reevaluate their views on the priorities and goals of President Trump by utilizing this interest rate forecast period, and this is the conclusion. What this means is that there is a 90-day tariff forecast period ahead, and during this period, it is advisable to sell a lot of stocks, as the stocks will fall a lot afterwards. This is the prediction. Well, I'll try to wrap it up in one word of wisdom. Personally, I do not agree with the content of the above article. Since this is just my personal opinion, it would be nice if you could understand that everyone has their own thoughts. The author of this article is fundamentally overrating President Trump, in my personal opinion. President Trump, the Communist Party's decision-making problems, and wealth inequality are issues that must be resolved, even at the cost of losing the next general and presidential elections. I disagree. I believe these figures are not that impressive. So far, if you look at the history of the United States stock market, the market has always surged when policies change at critical times. All politicians, not just the Democratic Party or the Communist Party, have always been corrupt in order to maintain their power and for the votes of the privileged. Therefore, my expectation and prediction is that they will not act differently this time either, and I will conclude like this. Therefore, they won't be different this time either. I will also conclude today's mid-broadcast with today's United States Knowledge video. I have been delivering the voice of a specialist every day through artificial intelligence dubbing, and the voice of artificial intelligence dubbing was very similar to the actual voice, wasn't it? So, even while listening, there is one fun factor that is very interesting. The artificial intelligence voice we will hear today is the voice of Professor Damodaran, who is working at New York Graduate School of Business. Professor Damodaran's voice is also very unique, so let's see how the artificial intelligence mimics it. Professor Damodaran is an incredibly famous investor, usually referred to as the Dean of Value Investors. Let's delve into how Professor Damodaran views the current situation and his thoughts on future prospects. This Friday's broadcast ends here. And as I explained earlier, due to personal circumstances, I won't be able to broadcast next week. Instead, I will try to share one United States stock video per day, where I will select and share what various experts are saying about the current market situation. We will all fight together until the day we retire from investing in United States stocks. Have a happy day. Thank you.
The market is still unstable after the big crash over the last 2 days. We will invite a professor, an authority on valuation at New York University's Stern School of Business, for a discussion. We would like to hear your opinion on the situation we have been experiencing over the past few days. How do you see the current market?
I'm starting to feel something is finally sinking in. If you look back at the previous crises, there were many cases where the initial shock was not the end. Even just looking at today, I can feel that the crisis is still ongoing. While I was waiting here, the Dow Jones fluctuated by 150 points up and down. It reminds me of weeks like in 2008 or 2020, when the market couldn't find a shape and kept fluctuating. And I think we can't say that the market has fallen into a panic state for no reason, because such a sentiment can have a long-term impact on the economy. There is a real reason why the market is reacting as it is now. Until we get a sense of what kind of pattern this instability will take, I see this more as a price adjustment of stocks rather than a panic sell-off.
Having studied various markets over the years, I'm curious to see how the market reacts differently in unprecedented situations like now, where the president's hand is tied by the backlash from the public. This is a situation where problems arise gradually over time, and it's a different dimension of market turmoil than what the market is worrying about. For example, the market was really bad for a while after the carry trade announcement in August, and it wasn't good for a while. Then do you evaluate the two situations differently?
No, I think it was an unprecedented event with COVID. I've never seen it before. It's not just an unprecedented event, but it's important in the sense that it could potentially have a long-term impact on the global economy. What I think makes this different from COVID is that this situation can change who holds the good cards in the overall scheme of the global economy. That's why I think this situation is more difficult than other crises. I wouldn't say the market is overreacting or being too complacent because we don't know how this whole process will unfold. Actual changes are coming, and the market is trying to reflect those changes.
However, that is a big uncertainty right now. If they are trying to reset the global economy and we take their words at face value, then we'll see. It means that it will cost more to produce goods in the United States. It means that workers producing goods will receive higher wages, and we may no longer be able to hold the price-fixing rights we once had. Therefore, we may not be able to maintain the same margin as before. As a result, profits will have to be reduced, and I believe that market share will also have to be reduced.
And do you know that? The back office might be okay with it. Over the past 5 to 7 years, it seems that the ultimate goal of the back office is not so much about how the stock market will turn out, but rather how the overall economic pie will be distributed to others. In fact, over the past 40 years, the share of the economic pie that stock investors have received has grown, and we must acknowledge that this has had consequences. And I'm not sure why the back office is so interested in the share of the market's economic pie. I think they might not worry too much about it if another group they've been waiting for a long time ends up taking a bigger bite than before. That's why this situation feels different. Usually in a crisis situation, the central bank steps in to stabilize the market and essentially put the unrest to sleep. But this time it seems to be the exact opposite situation. So it's not clear what the ultimate goal of this situation is. It doesn't seem like the current central bank's top concern is to keep the stock market rising. If you're a market participant, that's a problem, because the central bank is no longer prioritizing it.
I understand. But what is that? What is the purpose of that economic pie, for example? If a worker receiving minimum wage comes back to the United States and makes products in a factory, that would be the purpose?
That's really the ultimate goal. The crux is how much smaller the economic pie will get. If you make global translation more difficult, the global economic pie will get smaller. In that market, even the United States, the biggest player, will have a smaller economic pie, and depending on who gets what, the economy will weaken. I don't think anyone will have a bigger share than they do now when this process is over, but I believe the White House thinks otherwise.
Thank you.